Hi, I'm Richard Stutley and I am a portfolio manager at MGIM. I am delighted to be joined by Ian Lance from RWC Partners, which is a London-based investment management firm. We've been invested with Ian and his co-portfolio manager Nick Purves for over a decade. Together, Ian and Nick are two of the most experienced UK value equity managers. They manage high conviction, index agnostic portfolios that are built from the bottom up by focusing on the fundamentals of the businesses they own and the prices at which they are trading. We invest in Ian and Nick's UK equity income strategy across our portfolios, giving us access to a market that we think looks highly attractive today. Over to you, Ian.
Thanks very much, Richard. So the title of the presentation today is Value Investing Alive and Kicking. And I think it's a very pertinent topic to be talking about today because value investing is a strategy which has got a very long history of adding value, but actually it's been a strategy that's been out of favour for a number of years now. But actually in the last 6 months, it looks like it has come back into favour. And we genuinely believe this is a turning point for value investing. So today we're going to look at the fact that value investing is a very good long-run strategy to invest in. We're going to look at the fact that specifically UK equities today look very, very cheap. And actually within the UK, we're going to look at the fact that value stocks look very, very cheap to us. Finally, I'm going to try and make the point that we think that this rotation is really only just starting. And there are 3 reasons why we think it's set to continue. That's to do with the economic recovery. So let's jump right into that. So as I said, value investing is a strategy which I think most people know works in the long run. That's what we can see in this chart here. So in this chart here, we're looking at basically the returns of the cheapest third of the market based on price to cash flow, less the most expensive third of the market, again based on price to cash flow. And you can see this chart goes back for a long, long time. It's done on a rolling basis. And we can see that value as a strategy delivers very good long-run returns. There have been a couple of periods in which it hasn't worked. And as you can see on this chart, one of them was during the TMT boom. The other one is more recently. And we can see that in that historical period, the recent underperformance of value has been quite a marked one. But I think the main takeaway from this is as a strategy, it does deliver good long-run returns. And in this next slide, you can see that it doesn't just work in theory, it works in practice. Because what we're looking at here are the returns of our longest running strategy. We've been running this strategy since about 2000. And over that period, we've returned about 8% per annum versus about 5% per annum for the market. So when you compound that over that long period of time, that obviously represents a very significant period of outperformance. And of course, I would just stress the point that that includes the recent period of underperformance. So despite that, still a very good long-run track record. So it works in theory, but it works in practice as well. Okay, so let's move on to talk about this rotation that we've seen in the last 6 months or so. I think, as most of us know, last year the economy was very weak. That was as a result of lockdown. And then, of course, in November, we had the announcement that Pfizer had developed a vaccine. And what we saw within the market was a very large rotation out of more defensive stocks and into more cyclically orientated and value type stocks. And that's what you can see on this slide here. I mean, you can see here that there are lots of stocks within our funds that have gone up between sort of 50 and 120% since the announcement of that vaccine. And the question is that the start of a new investment regime? Is this the start of a long rotation to value? And you can see it again on this slide. So this slide is actually showing you the performance of sectors from the start of 20 through to the announcement of the vaccine, and then the performance of sectors from the announcement of the vaccine through to today. And again, you can see that complete rotation within the market. The sectors which had done badly in the previous period actually were the sectors which led the recovery coming out of this. So again, you can see a very sharp rotation towards value. So I think this is the question on everyone's lips: is this just a flash in the pan, or is this value rotation something that's sustainable? We think it is sustainable. We think there are three reasons for that. I'm going to go into detail on each of these. The first one is that the dispersion in valuations between value and growth are as wide as they've ever been. So the starting point is very, very attractive for value. The second point is that the repositioning of investors from growth to value has only just started. Most people are still very, very overexposed to growth stocks. And the third point is that we think that the next few years is likely to see a sort of reflationary, even inflationary environment. And as we'll come on and see, that those environments tend to favour value stocks. So let's start with the first point, the dispersion in valuation. And we're actually here looking at the valuation of the UK market. And you can see that this chart goes back nearly 50 years. And we're looking at the valuation of the UK relative to MSCI World using PE, price to book, and dividend yield. And if you look at the black line in this chart, this tells you the average discount that the UK has traded at over the last 5 years. And it's been about 17% discount to MSCI World over that period. Today, we're trading at actually a 45% discount. So that suggests to us that the UK market is looking very, very cheap relative to MSCI World. And if you are someone who believes that low valuation is the best guide to future returns, then that should be attractive to you. And I think another interesting thing that we've observed within the last sort of year or so is that that fact that of the UK market being very cheap, I think, has been proven out by the number of takeovers that we've had within the UK market. I think, just to give you some examples, we've seen Morrison's bid for, we've seen Meggitt bid for, we've seen Ultra Electronics bid for. These are international investors who are committing large amounts of capital to UK companies, and I think that's on the basis that a lot of these companies are very cheap relative to their international peers. And so I think that's a sort of genuine proof, if you like, that the UK market is very cheap. If we look within the UK market, I think the second thing that we can observe really is that value stocks look very cheap. On the left of this chart here, we just have the performance of value relative to the performance of growth. And you can see it's been a very bad period for value versus growth. But if you look at the right-hand side, what we're looking at here is the gap in valuations between value stocks and between growth stocks. And again, you'll notice that this is a very long chart. This is a 50-year chart. You can see, if you, for instance, go back to the 2000s, right at the top of TMT, you can see how wide the dispersion was between value stocks and growth stocks. Now compare that with where we are today. The dispersion between value and growth is larger today than it was right at the peak of TMT. And let's remind ourselves, after that period from 2000, we had about 5 consecutive years of very strong value outperformance. And today's starting point is even better than it was back in 2000. So I think that gives us a lot of confidence that value within the UK is a really interesting subset at the moment. On this chart, we've actually looked at the performance of value during all the value rotation periods. And I think we'll just make 2 observations here, which is that the current value rotation really has only been going for about 6 or 7 months. We can see here that the period of performance on average tends to be about 60 months. And we can see how significant the periods of outperformance are. So if you just look at history, that would tell you that these value rotations tend to go on for a long period of time, and that the outperformance is very significant. And if you compare that to where we are today, it would tend to tell you that we're really only in the start point of this value rotation. Moving on to point number 2. I said that we haven't really started to see investors adjust. And what I mean by that is lots of investors, because growth has done so well for so long, are very, very overexposed to growth and very, very underexposed to value. And that's what this chart is showing you. It's effectively showing you that value funds have had years and years and years of outflows. Growth funds have had years and years and years of inflows. And you can see that has literally only just started to change in the last few months. Last few months, we've started to see growth funds getting outflows, value funds getting inflows. But again, we're really only in the early period of that. And I think there's still a lot of rotation to go. Moving on to my third argument. My third argument is that we're likely to see a global economic recovery in the next couple of years. And I think really there's no sort of debate about that. We have indeed in 2021 seen a very strong economic recovery. And that's to be expected. Last year, large parts of the world economies were locked down. And this year, of course, we've come out of that lockdown. Economies have rebounded. So we've seen a big economic rebound this year. And that's around the world. So we've seen it in the UK, we've seen it in the US, we've seen it in the Eurozone and in Asia as well. And forecasts suggest that will continue into 2022 as well. So the backdrop is one of a strong global economic recovery. If we look at this chart, this is based on sort of historical data, and this is fairly intuitive, I think, to most of us. If we look at what does well and what does badly during a period of global economic recovery, what we'll see is that typically defensive stocks, quality stocks and growth stocks do badly during a period of economic recovery. And indeed, that actually has been what has happened since November of last year. Those really have been the laggards. What does well, and again, this is sort of quite intuitive, I think, it's sectors like financials, it's value, and its cyclicals tend to lead during an economic rebound. And again, that is indeed what we've seen. And given that we think the economic recovery is likely to continue, that is supportive, we think, of value stocks. And what's really interesting, actually, is if you look at what is going on within markets at the moment, we can see that you can see why value stocks are leading the rebound. So the chart on the left-hand side here is actually looking at earnings growth by sectors. And what you can see here is that it's the value sectors which are leading the earnings growth at the moment. So it's things like energy and materials and industrials are actually leading the earnings growth. Now, of course, that is coming off a low point, but nonetheless, those are the sectors which have got the greatest earnings growth for this year and probably for next year. Whilst over on the right-hand side of that chart, you can see that actually it's the more defensive sectors, as you would expect, are not really getting that much earnings growth at the moment. So value stocks are not only cheaper, but they've got the strongest earnings growth at the moment as well. Chart on the right-hand side here is actually looking at earnings revisions. And what we're seeing is that, again, it's the value stocks. Not only have they got the fastest growth, but they're getting the greatest earnings upgrades at the moment. So again, sectors like energy, materials, etc., are the sectors which are getting very strong earnings upgrades. And actually, it's the more defensive sectors really which are getting downgrades at the moment. So I think another data point that is very supportive of value today. The final point, which we think again is supportive of value stocks, is the fact that there must be a chance that we see an increase in inflation in the next couple of years. We've already started to see inflation pick up. Now, of course, the central banks are telling us that pickup in inflation is transitory and that it's going to go down. But I don't think you can rule out the possibility that it's not transitory. Let's remember the central banks have a vested interest here to say that it is transitory. And I think that given some of the things that are going on, there's got to be a chance that inflation is going to pick up in a sustained way. And really, I'm just going to point to two things here. The first one is the massive amount of fiscal stimulus that is being thrown at the economy. The chart on the left-hand side here looks at the fiscal deficits that have been run in all the recessions back to 1980. And basically then the second to bottom line adds those up. The bottom line is the fiscal deficit that has been run in the last year. So what that's telling you is that the fiscal deficit run last year is bigger than the cumulative deficits that were run in all recessions back to 1980. That is an enormous amount of fiscal stimulus being thrown at the economy. And, ordinarily, when that amount of fiscal stimulus gets thrown at the economy, it tends to lead to a pickup in prices. Over on the right-hand side, we're looking at monetary stimulus here. And again, the point that we would make here is that between about 2010 and 2018, the Federal Reserve increased the size of their balance sheet by about $4 trillion. So it took them about a decade to increase the balance sheet by $4 trillion. Last year, it took them about 6 months to increase their balance sheet by another $4 trillion. So again, an absolutely enormous amount of monetary stimulus being thrown at the economy. And just those two things together, I think, would tend to suggest that you can't rule out an increase in inflation, or at the very least, you should be thinking about hedging the possibility of a pickup in inflation. So how can you do that? Well, again, we would say that value stocks are a good way to hedge against a pickup in inflation. And the chart we're looking at here actually looks at the performance of different sectors during periods in which inflation is increasing. And again, I think this is quite intuitive. It's the bond-like sectors tend to do quite badly in a pickup in inflation. So it's things like utilities, consumer staples, healthcare, and so on and so forth will tend to do badly. And that would be expected, as I say, they're bond-like sectors. But again, it's the value-y type sectors do well in an increase in inflation. So as we can see here, it's things like financials, energy, materials, etc., tend to be the sectors. And therefore, this tells us, if you are concerned about a pickup in inflation, then I think increasing your exposure to value at the moment is a good idea, because effectively what you're doing is you're buying yourself a cheap inflation hedge. And our strategies, we think, are very well positioned to pick up, to benefit from that pickup in reflation or inflation. So if we look at if we just go back to the sectors which we've shown in the last few minutes, tend to lead during a reflationary or inflationary environment. It's things like financials, materials, energy. And you can see that our portfolios are very well exposed to that. So about a quarter of the portfolios in energy and materials, about another 20% or so in financials, and then very low exposure to the areas which do badly. So healthcare, consumer staples, virtually no exposure to there. So we think the portfolios are poised basically to benefit from any reflation or inflation. And that's certainly what we've seen over the last 6 months or so, and I think what we expect to continue. Okay, so if I just sum up what I've been saying for the last 20 minutes or so, the first point, I think it's worth reminding ourselves that value investing is a very good long-run strategy. There are not that many strategies which have been proven to add value over the long run, and value investing is one of them. I think the recent period of underperformance doesn't prove that value investing doesn't work anymore. It actually represents an opportunity to get into a strategy that works in the long run, but to get into it at a point at which it's very, very cheap. The second point that I made was that we think that the UK market represents terrific value today. You'll remember when we looked at that, the UK market is at the widest discount to MSCI World that it's been for about 50 years, and we think that represents a real opportunity. Within the UK market, value stocks are at an enormous discount to growth stocks. Again, just remember that a wider discount today than they were back in 2000, right at the top of TMT, a period which basically led into 5 years of fantastic performance from value stocks. And the final point is that we think that the environment today is really suited towards value investing. So it's likely, we think, that we see an economic recovery for the next couple of years. It's possible that we see a pickup in inflation. And as we've seen, we think that value sectors are the types of sectors that benefit in that sort of environment. I hope that's been interesting, and thank you very much.
Thank you, Ian. That was great. Ian is available now in the live chat, so please post any questions that you have for him. Next up after that is a comfort break, where we will be showing one of our videos, so do please stick around for that. Please also feel free to take a look at our exhibition centre, where you'll find a host of information about the various products we offer, catering to different regions across the globe. Please enjoy, and we'll see you back afterwards.